Today we will be having a coverage update on three counters. There's SGX Kogan, and the last one is actually the silver as a commodity. For SGX update, okay, the securities market turnover is actually hypothesizing but there's a slight dip in February for the SGX main board Singapore dollar. But overall, the market turnover is actually higher because of the non-Sing dollar, as you can see here. For the month of March, we expect it to be better for both Singapore dollar and non-Singapore dollar, as you can see that the financials have rallied in the first few days of the month of March. And we can see here that the biggest boost is actually from overseas companies as well as China. The value has picked up here, right? And Singapore dollar is slightly lower than the month of January. We will continue to see volatility in this area of this segment of the business. And I mean, in order to boost the growth area, we find that the segment of connectivity, market data and connectivity to be more promising in terms of growth prospects. So we'll touch on the Baltic exchange business, the proposed acquisition. And most people on first impression is that they are doing it for the derivatives. But looking at the annual report for the Baltic Exchange, it turns out that actually most of the £6 million of revenue is from membership activities, and that is about £4.8 million, and most of it, £2.6 million, is from membership subscription and member access. Okay, so the revenue from Baltex itself, which is actually the bulk processing of freight freight agreements, is actually £136,000 from January to March. If we put it together with the rest of the revenue, it's actually not as significant. And the online sales of information from direct subscription is actually £350,000 itself. So the sales of information itself is very promising, and we feel that that is a portion that belongs to, if SGX were to successfully acquire it, that will belong to a portion of data and connectivity. So where the potential would lie is, if we can see, SGX has very strong business in iron ore swap. So the dry bulk FFA would mean that dry bulk would be iron ore, steel, grains, and in this area of the business. And SGX has already got a finger in those in that area of business. And so we view that SGX could also grow the FFA volumes, right? Because now it's already a clearinghouse. As you can see, SGX Asia Clear is one of the clearinghouses for FFA. Currently, this Baltic Exchange is working closely with LCH ClearNet, and we can see that moving forward there could be more synergy with SGX Asia Clear. And that SGX Baltic Exchange could also leverage on SGX digital infrastructure to increase the online sales of information, and also to extend the other services of dispute resolution, mediation, arbitration, and training. So we have a target price of $8.28. The last close is $7.64, based on Friday's close. And there's an increase of base dividend from 4 cents to 5 cents per quarter, and together with the 12 cents per share at the final dividend, the yield will be about 3.9%. Okay, that ends my presentation. Thank you.
Hello, good morning. This is Richard speaking. I'll carry on the presentation on Cogent Holdings. We published the results update last week. So we still maintain our buy rating for Cogent Holdings with a new higher target price of 64 cents. The last close on Friday was 46.5 cents. We still like Cogent because of its strong cash flow generating business. So I'll take you through this table line by line. First of all, revenue for the full year increased by 9.1%. This was driven by the warehousing operations at the Integrated Logistics Hub, Container Depot Management Services, and Automotive Logistics Management Services. EBITDA was up 15.6%. Some of this contribution in FY15 of higher EBITDA was because of lower rentals on leased premises, which was lower by 2.6 million due to cessation of two warehouse leases during FY14. And this was partially, this reduction in rent was partial in FY14, but the full effect was in FY15. And then for EBIT, it was 13.5% higher. There was some high depreciation of depreciation was higher by 1.7 million due to the Cogent One Logistics Hub. So to summarize this part about the rents and the depreciation, we have been maintaining that for Cogent, when it consolidates its operations to its integrated logistics hub, it will derive some cost savings by reducing its rent and replacing it with a fixed depreciation charge. And so we've seen that here in the EBIT, where it grew by 13.5% through cost savings. PBT level also grew 6.8%, but there was higher financing costs of 2.1 million in FY15 due to expensing off of borrowing costs upon completion of the logistics hub. Net income was 3.3% higher year on year. There was a disproportionately higher tax because FY14 profit includes a substantial gain on disposal. So this will tie in together with the adjusted net income. This disposal of property was for One Chiaping Road, and it had a one-off gain of 5.9 million. So from here, if we exclude out the 5.9 million from the 24.7, we'll get a 18.8% recurring net income for FY14. And so that's how we get a 36% year-on-year increase for recurring net income. So the next three bullet points will be, firstly, there was effective cost controls through the successful consolidation of their operations to the logistics hub. Rental expense was actually down 8.8% year-on-year, and although depreciation expense was higher by 22% year-on-year, but net, these two expenses add together was down by 2.3% year-on-year and resulted in a saving of 875,000. Next, second bullet point is a significant year-on-year growth in FY15's adjusted net profit after tax. So I have explained this earlier on excluding the one-off gains of 5.9 million to get this 18.8 million here and resulting in actually a 36% year-on-year growth in net profit. So, and this actually outpaced the 9.1% growth in revenue, which again is evidence of the effective cost controls. Lastly, for dividend, they had a lower final dividend which was proposed. This is 1.88 cents, representing a 35.3 payout on recurring net income. This is lower than FY14, where FY14 was 2.58 cents and 65.8% payout. The reason for the lower dividend proposed is because they are retaining cash in anticipation for the Jurong Island project that they are retaining cash in anticipation for a Jurong Island project. So to conclude, we still maintain our buy rating on Cogent Holdings, target price 64 cents. We'll now move on to the next part of the presentation.
Morning guys, Jeremy here. So I'll touch a little bit on silver based on technical analysis. So where do we see silver heading to? The key point I want to emphasize here is the 200 moving average. It's actually a very crucial level. As you can see, since August 2013, the 200 moving average has been capping price in the downtrend. And the recent bearish price action suggests that there's a highly likelihood of price falling back down to test the 14 to 1365 support area again. I will show you what I mean by that. So here's the chart that illustrates the significance of the 200-day moving average. So this is the daily chart, and as you can see, the green line over there is the 200-day moving average. And every single time when it does test the 200-day moving average, it gets rejected significantly, and what follows suit after the test of 200-day moving average was some sharp fall. Price has been rejected by the 200-day moving average for the past 6 attempts, and the current price action around here is the 7th attempt. The bearish close below the 200-day moving average from last Monday gives us some clue that price might actually be heading down again, just like how it did in the past 6 attempts when the 200-day moving average successfully moved price down. To give you an updated view on where price is now, we'll take a look at the current price chart of silver. So this is where we stand now in terms of where price is. So the report on silver came out on last Monday, which was this big red bearish bar over here. And as you can see, the bearish follow through wasn't a strong one, and price managed to creep back up above the 200-day moving average. But however, what I want to point out here is last Friday from the non-farm payroll data, there was actually some explosive move on Friday, shown by this big bullish bar. To point out specifically, look at this upper shadow over here. It's actually showing some sort of a weakness of the previous high around the 16 level. So we still hold to our view that the bearish sentiment is in the background, and we expect price to continue to head back down to test the 1366 level if it manages to close back below the 200 moving average. And on the upside, watch out for price action at around the 16 level, which was the previous high from Feb 11. So moving on, The next part that I want to focus on is this is the zoom in view of what was happening recently. We actually came out with a report back in 2015 showing the significance of the 200-day moving average, and the report mentioned that we see bearish follow through coming in after this bearish engulfing bar, which it materialized, and this is what we are having right now, as I mentioned just now. So our view is for price to continue to fall to test the 14 to 1365 support area. The next part I want to focus on is the spread between the rally highs and the 200-day moving average. So what I mean by the spread is basically the gap or the distance between the high of the rally and the 200-day moving average, which I will show you shortly in a while in the next slide. Since August 13, we have seen that the wider spread was around 86 pips, and coincidentally the current spread is also at around 86 pips. This tells us that 86 cents is the threshold for which how far the sellers are allowing the bulls to run for. So in order for the bearish sentiment or this downtrend to really change significantly to the upside, we will need to see a strong break above the 86 cents threshold. So here's the chart to illustrate the gap or the spread I'm mentioning about. So basically the spread is just the difference between the high of the rally as well as the 200 moving average. So this was from June of 2014, which happened to be the widest spread of 86 pips. And as you can see, the subsequent spread was only in the range of around 34 pips to 52 pips. So this was the current price action that we're getting, and the spread happened to be at 86 pips as well. So what I want to point out here is in order for this strong downtrend to really reverse and turn back into an uptrend, the buyers really need to take out this previous high from around 16 level and to significantly break above this 86 cent spread. However, the current price action still suggests this relationship of the 200-day moving average capping price in this downtrend. So in conclusion, we believe that silver will continue to drift lower in the meantime, to test the 14 to 1365 support area in search of a new bottom. If this does happen, this would tie in nicely with the silver area cycle bottom, like the one we have did for gold, where you see that silver should and could probably bottom out around May to October of 2016. So, and from there, we believe that the next big leg up should happen when the break of the 86 cent spread happen will be our first clue of this cycle bottom to happen. Next, I'll pass on to Vincent a little bit more on technical shift.
Thank you, Jeremy. Hi, good morning, everyone. So just to give everyone an update on an announcement that OSIM released this morning. So RONSIM has actually officially offered an unconditional cash offer to privatize OSIM at the price of $1.32. So our last target price given was at $1.38. So that the current offer price at $1.32 is actually about 4.5% discount to our target price. So given the current market condition, the current sentiment as well as volatility, so we think that this discount is justifiable, and we would recommend investors to take up the offer. With that, we would like to end our presentation. So we shall open the floor to questions.
Hi, there's a question on what is our view on gold. We actually did a report back in the start of the year 2016. You can actually refer to the report from Poems. But basically, our view is we are bullish on gold. We actually called for a certain bottom to go around May to October of 2016 this year. But apparently, gold has been rising up for the past few weeks. And as you can see over here, this is the gold chart. So one to point out here is gold has been rallying up since it broke above this high. And right now we are at 1259 level, which is around the 200 weekly moving average. So the thing to watch here is price is currently also testing this particular 200 weekly moving average, which would be a key uh, barrier for the buyers. So we actually got a close above this 200 weekly moving average last week. And the thing to take note is to watch how it closes this week, because this will form the basis in which the next course of direction will be decided on. Uh, if it manages to stay and close above the 200 weekly moving average, chances are that we should continue to move up higher. However, if it closes back below the 200 weekly moving average, then price will actually start heading back in this downtrend again. I would like to repeat that we still believe that the gold might actually bottom out around May to October of this year, which would take us about 2 more months. So we just watch out for that. And there is a question asking for the spread between the rally high and the 200 moving average on gold. As you can see, gold actually have been performing much better than silver in terms of the movement to the upside. And we have way surpassed that particular spread that I mentioned in silver. So definitely gold is more bullish than silver now, and thus the spread relationship isn't holding up so well for gold. Regarding the 200 days moving average, the 200 day moving average that we are using is the exponential moving average. Yeah. For STI, hi, for the questions on STI, I'll give a brief update here. As you can see, we get actually some strong bullish price breakthrough last week, where it actually closed above the 20 weekly moving average as well as this strong downtrend line. However, that doesn't really throw out away this downtrend that we have been seeing since the end of 2015. You can actually draw a downtrend line from the peak to this point over here, which still more or less validates that we are still in a downtrend. And moreover, there is some overhead resistance that we are seeing right now at around 2808 level. Price is actually reacting to this particular resistance now, as shown by the current price action here. So it'll be important to watch how price moves in the days coming ahead. And a close back below the 20 weekly moving average will actually be quite a bearish sign. So this is the weekly time frame chart I'm looking at. And if price manages to close back below this red line, which is the 20 weekly moving average, then we could actually see the reversal back into this downtrend.
Hi, morning guys. The Hong here. There's a question on Fraser Center Point and the recent price correction for FCT. Whether is it because of the AEI coming online soon for one of their malls? I don't think the correction is due to the AEI because the AEI has been public information for a long time. So it's not as though like the market suddenly realized that FCT is going to do AEI for one of their big malls. So it has been public information for a long time. Corrections now and then has to be because of market sentiment, but as a whole, management has already committed to improve DPU despite this AEI. So I think this is one of the REITs, one of the trusts with the most stable DPU that you can buy. We still have a target price of $2 for it. So short answer to the question will be price correction is not due to the AEI. Hi guys. So if there are no further questions, we will end the webinar here today. Thanks for tuning in and hope to see you guys again next week.